Closer look at the markets here and reaction to the geopolitical news overnight. S&P is down 0.6%. Scott Chronert joins us, Citigroup U.S. equity strategist. He's here at post 9. He raised his year-end S&P target to 6,300 this week from 5,800. So kind of catching up with the market here, I guess, as we continue to make new highs, although a step back today. How do you think that what happened overnight impacts the U.S. equity market, if at all?
Yes, Sarah. So the way we've been talking about it is, okay, great. We've pushed our target higher, 6,300, roughly 5% upside in the second half of the year. Got that. We know that we're going into this with a close to overbought condition on the Nasdaq, at least, to a certain degree the S&P, and volatility's come down quite a bit. You see that in the VIX levels, which have begun to come off the bottom recently. So what we had said was, like, this is probably not going to be a year of summer doldrums. There's going to be ongoing volatility metrics that come into play, whether it's policy related. Now we have geopolitics coming back into the equation here. Our presumption when we usually look at these types of activities is obviously the path you go is escalation or not. But from there, it's like starting point for us is what's the impact going to be on global macro conditions? What's global GDP going to do as a result of this? Okay, and that, we'll see more on that, but my guess is probably limited. What that then does in my framework is come back to probably not a massive influence on underlying S&P fundamentals. Bottom line, initial take here is be prepared to buy volatility-related weakness.
Well, 7.5% move on oil prices is not nothing. I mean, there are those who worry about sort of 1970-style stagflation. We've got tariffs coming in, haven't seen an inflationary impact there yet. But if we do see a sustained move higher in oil, is that a concern?
At some level, it's a concern. It's going to be the sustainability of it. There's always like a be careful what you wish for on this. So, and when we look at our S&P earnings profile, for example, start of the year looking for 270. We're now at 261, and we had come down. Wouldn't you know, the energy sector has been the biggest drag on S&P earnings versus where we started the year. So, so what you end up potentially get here is some relief on the fundamental front for that part of the market. I completely get the inflation read-through. Again, that's going to have to be a little bit more of a protracted higher oil price setup, and there's been a lot of discussion about still many sources of supply to be tapped into. So we're not going to stretch too far in terms of presuming a persistently higher oil price at this point, but certainly that's going to be on the radar.
How much of your view has been contingent on an easier Fed in the back half? And does today, if it's sustained, make that more difficult?
So I would say not much of our view. Like, we've been presuming consensus. You get another Fed cut or two into the end of the year. Honestly, I think the consumption trends that we've been looking at support a Fed ease, but that's a little bit more of getting ahead of the data. And the Fed has shown a proclivity to want to see the data. What is really contingent, though, on Carl, is that, we've begun to, move away from this tariff overhang. You're seeing the company-specific responses, and companies aren't standing still on this. And at the same time, you've got the ongoing AI tailwinds that are probably, if anything, broadening now versus where we were 3 months ago. So we think the underlying inertia from a fundamental perspective is actually in pretty good shape, with this issue regarding broader economic activity out there as a potential sore spot, but not a big swing factor yet.
So not necessarily any danger of tariff hurting margins, hurting CapEx, right? That's been one worry.
We're not seeing it. The CapEx numbers, if anything, are broadening, right? And what I would come back to at the same time, which is so fascinating about this market, is you're seeing the repurchase activity pick up as well. We've been talking for a while now. The S&P has been in this mode where it's reducing its fully diluted share count by about 1% a year. And we had said earlier in the year, $900 billion in repurchase is probably line of sight. You could get to $1 trillion. The trillion's looking to be pretty conservative at this point. So a lot of free cash flow generation. It's translating into financial flexibility, CapEx down the AI path. And this repurchase activity, companies are taking advantage of volatility in their stock prices to be aggressive on the repurchase front.